It's been kind of interesting with rents kind of flatlining, taxes skyrocketing, and insurance skyrocketing. We have a lot of houses that were cash flowing, call it by 20%, that are now break even. But I was looking at the spreadsheet just the other day. There's millions in trapped equity there that's no longer generating a real return. I just got a capital call last week from one of the syndications I'm a part of. You're not the just so everyone, he's not the general partner. He's not. I don't. Best I know, he's not involved in the deal even as an LP. But I mean, capital calls are a real thing. It was a value add deal I invested in 2021. Rates moved historically 3 times. What they were. Cap rates have compressed. Could you just tell people the real frickin' truth about the multifamily market today?
So what I'm seeing today is the debt situation is challenging to make the numbers work, but you're getting a low cost basis compared to 3 years ago. So it's a good time to buy as far as, the average per door if you can make the debt work. So ways to make the debt work would be a loan assumption deal potentially, or a seller financed deal. Those are things I've been looking at. But even using agency debt, the treasuries, depending on what they're doing, a few weeks ago you might have been able to get high fives on interest rate. Maybe not this week, but it has been challenging, and deals aren't cash flowing as well, or some not at all, and a lot of deals are running into problems like yours, where I don't know if yours was a bridge loan, but there's a lot of bridge loans that took place during COVID. They're coming up on their term, and they don't qualify for the extension, and they're faced with either capital call or sell for a loss or another creative way out of
preferred
it.
equity or whatever. That's what's been interesting. And so my wife and I on our single family stuff, it's been kind of interesting with rents kind of flatlining, taxes skyrocketing, and insurance skyrocketing. We have a lot of houses that were cash flowing, call it by 20%, that are now break even. But I was looking at the spreadsheet just the other day. There's millions in trapped equity there that's no longer generating a real return. And I was like, we'll just start selling these houses because they're all below median home price and should still sell at or near the peak for that area, and take 100, 200 grand at a time out of these houses when they sell. Because if you can invest in a multifamily deal right now that works in today's environment, I'm kind of with you. Like, it's just going to work better in the future. I would say, though, I want to know your opinion on this. My personal opinion, one that I invested in last week, actually, seller finance, first, 5% interest on a 10-year balloon. I mean, just can't find better than that, right? We raised like 30% of the purchase price was equity that we were raising, or that they were raising, my friends. But we underwrote it on in place versus pro forma. Could you maybe tell the audience a little bit about how your philosophy's changed in the last couple of years of pro forma versus in place?
Yeah, well, a few years ago, when you're at the top of the market, we're trying to underwrite like a very conservative exit cap rate, and look what happened. So a good thing we did. But now, I'm seeing that the exit cap rates aren't as they're more aggressive now, because we're hopefully at the bottom or the worst of it, or close to it. But yeah, I think recently I'm seeing more of that, where the going in cap and the exit cap are closer together.
Right.
I was going to bring that up because, like, I'm not a multifamily investor, but I'm friends with a lot of them.
But you are on TV.
Yeah. Well, I play one on.
You play
TV.
one on
Yeah,
TV.
yeah. No, but it's just like, unfortunately, the only people I know who do it are very successful at it.
Right.
So I have a very biased, skewed view of what being a multifamily investor is. In my mind, it's you buy it at 10 cap and you appreciate the hell out of it to a 5 cap, and you make out like bandits. But then I see all these deals that are going across, and they're all already a 5 or 6 cap, and you're like, where's the meat on the bone? But what you just said makes sense, because it's like you're not looking for that 5 or 6 cap spread. You're just looking for a little bit, I guess.
Well, and it helps because I try to do value add as well. So it helps to have, are the rents below market? Is there a lot of classic units? Is there a lot of potential to, you don't have control over the market, but you have control over those things. So is there opportunity to save costs, opportunity to increase revenue? That way you have more control over forcing that value.
In place versus pro forma. What does that even mean?
Well,
because I don't know.
Yeah,
what
it goes
means.
to the question. So, in place means so you have 100 units rented at $2,000 a month. What you saw a lot in 2020, 21, and 22 was syndicators saying, "Oh, well, we're going to get the rents up to 2,500," and so they would model the exit off the pro forma rents.
Okay, so pro forma would be like the potential future.
Yeah.
Okay. So in place is now, pro forma is potential
Right.
future.
Right.
Cool.
So
Right. Sorry to interrupt your question.
No. In multifamily, they have this thing called a T12. It's the trailing 12 months kind of income statement. And I would say previous to 22, I'd say 2019 through 2022, people kind of didn't even look at the T12 because they knew they could raise rents 20, 30%. They could put in a pool or a pickleball court or whatever and get a bunch of people to pay 20% more in rents. So they only looked at pro forma. The investors I know that are super serious with big checkbooks right now are underwriting the in place versus the pro forma. And if you can make the deal work off what it's doing right now, right, with maybe assuming cap rates go down 1%. That's the other thing. So the difference between a 10 and an 8 on a cap rate is not huge, right? Because percentage-wise, it's 2%. The difference between a 6 and a 5 is about the same because it's about 20%. So the more compressed you get, the lower the number, the less you have to move to have real
Right.
improvement.